You guys, this is Nick Legamaro. He's a member of the SubTo community. He's one of the smartest people on the planet. Very creative. In fact, this man has been melting my brain for like 7, 8, 9 years. Years before we launched the SubTo community, and he's done crazy, crazy creative deals. Can you? Hey, good to see you, brother.
See you, man.
Did you move your son out?
He's here. We're getting in the car tomorrow, going back to Dallas.
The reason I invited Nick Legamaro over here, let me clean this up, is I'll kind of explain. Nick Legamaro is a good friend of mine, really, really smart. He'll do deals with you guys in SubTo as well. He's done probably hundreds of deals with SubTo members. Would you say that's correct?
Easily.
Easily, okay? So we have a lot of leaders in this community all over the country. Nick will help out with all sorts of crazy things. And you don't see Nick on a lot of the Zooms. Just like a lot of our leaders, you're not gonna see a lot of them on the Zooms because what are they doing? They're actively getting deals done. And so you guys have to make an effort to network with the people in the community that really do want to help you. But I even text Nick and I'm like, hey, I have a conundrum. Will you workshop this with me? Okay. So I'm going to kind of work through this with you guys, help you understand. We're not talking about SubTo anymore. Cool? We're going to talk about notes. This is going to be high level. It's going to fry your brain for a couple minutes. Okay.
I'll try and keep it slow.
Don't. Let's just
Are you sure about that?
Yeah, I'm sure. All right, so here's what I've got going on. So I own a tiny home manufacturing company. Okay, and this tiny home manufacturing company last year built and sold 250 units last year. I want to grow this company to 1,000+ units all over the country. So as I go and do this, the number one way for me to brand myself is to be the person that will finance a buyer 100%. Imagine if I told people, I'll build a tiny home for you, ship it, deliver it, and install it, and I will do no payments for 2 months, and I will get this thing on your lot. Do you think I would sell a lot of units? Yeah. Okay, or I could go spend a bunch of money on marketing, get salespeople. Salespeople are a nightmare. So I'd rather just freaking have my best salesperson be my financing arm. Okay, cool. So the thought is, if I'm gonna go do this, the way to do this is I put together, let's say $5 million in cash. I either raise this money or I pull it out of Nick Legamaro's pocket, I don't know. But I'm gonna go put $5 million of cash together, okay? So a buyer comes to the table and the buyer says, I wanna buy this tiny home. The tiny home, let's say, is gonna sell for $129,000. And my cost basis on this, Nick, is $85,000 for this higher end version, okay? There's lower end versions that have a lower cost basis.
Is this just manufacturing is land as well?
Manufacturing and shipping included. So it gets to the customer for the $85,000.
And who owns land? They do?
They own it, or in some situations I do on the first like 5 or 6 that we're gonna do. The first test I'm gonna do is in Big Spring, Texas, where I'm gonna buy 40 for myself, and I'll be the first customer that goes through the Legamaro pilot program. Okay, so 85,000 is my cost basis. I can get the tiny home built, shipped, and arrive at the customer's property for $85,000. So what I would do here is I would, in my first original thought, is I would cover the cost out of the 5 million. I would create a note. I would create 2 different notes. One note to the buyer for $85K, and another note to the buyer for the remaining $44K.
Okay.
Okay. And that note, as you already know, and what we're going to talk about, is a second lien. And I'll probably charge, I don't know, 9 to 12% interest on this.
Okay.
This same thing, it'll probably be like an 8 to 10% coupon or note, sorry. And I want to go and sell this on the market. Did you guys know you can sell notes? Okay, Nick has sold and bought more notes than anybody I know. So this is why I brought Nick into this. So if I sell these, what can I do with that money? I can recycle this money back into my pot and I can finance another customer. Does this make sense? What have I done here? I have a customer that comes to the table. Here's the customer in red. And the customer says, I could probably buy another tiny home for like $115,000, $118,000, but I got to come up with all the money for that. Pace is willing to finance me. I'm going to go with Pace. Do you see what the allure is? I can make more money and I can make more money long term. So I only have to pull money out to cover my cost basis, right? The $85,000. If the customer is buying it for $129,000, why don't I have to cover the $129,000?
That's on a note.
Right, so I only need to really cover their 85K. And so that note is going to be created as a loan. That loan needs to be crafted and curated in a way that I don't know how. So I'm going to rely on Nick to help me with this, because I want to be able to go find a secondary market that it's a bunch of old guys with gray hair, by the way, that are all like, we want those notes because we want the passive income that comes from them. So they're going to buy that paper from me, maybe for 80K or something along those lines. Maybe they'll buy that note at a discount, and guess how much money they're making on their money? Pretty good return, right? Cool. So the benefit there is they buy that. You see their benefit, what they want, right? They don't want to sell tiny homes. They don't want to find the customers, but they want to buy passive income notes. Does this make sense? Did you know there's millions of people that do this for a living? It's bonkers. Bonkers.
Millions.
Millions of people do this, okay? So a lot of them are individuals. Why do they buy notes? Because it's passive. It actually is basically passive. It's like playing Pokemon cards, right? If you buy the right Pokemon cards, you can make some money, right?
Let me say something to put that in perspective. This past year, the private mortgage note creation business went over $30 billion.
Wow.
$30 billion and when I say $30 billion, that's mortgages that have been created by individuals that are
That's not by banks.
Not named Wells Fargo, Chase, Bank of America. Okay?
$30 billion.
$30 billion. It's a pretty big market that most people don't know about.
So if I want to create these notes, I obviously have to cover the cost of the home with my coffers right here, my $5 million. I cover the cost for the manufacturing, the shipping, so I have no cost basis. My cost basis is covered. My customer now has a tiny home on his property. He has two loans, right? Loan number one, loan number two, and he has two separate payments. I now want to take that money and recycle that money so I can go help the next customer. And so I need help with a handful of things. Number one, finding enough note buyers with a big enough appetite that I could go do this 1,000 times a year. That's going to be my number one problem. Number two, curating the note and crafting the note in a way that makes sense for them, because you know this better than anybody. There's been people that create notes and they do it wrong.
All the time.
All the time. And then if they do it wrong, what does the buyer do? They don't buy.
Well, what happens is everything's got a value, right? I love when you talk about the F-150 example, right?
Yeah.
2015 F-150, 100,000 miles, white tan interior. But are all 2015 F-150 pickup trucks the same?
No.
Some are beat up. Some are in pristine condition with perfect maintenance records.
Right.
Right? Which one has a higher perceived value?
The maintenance records.
Absolutely. That's what we're doing when we create the note. We're
Okay, so
stacking the file with all the proper information.
So the file would be, number one, the borrower is going to be really important, right? You're going to underwrite or take this person through
underwriting an RMLO.
Okay, an RMLO, registered or
residential mortgage loan originator.
Okay, so somebody who's licensed to be a loan originator is going to underwrite this individual. So the borrower will have to be looked at by an RMLO. This costs us, I don't know, $500?
Probably more than that, but
okay, $700?
It depends on who we do. We could bring it in-house.
Okay, cool. So the borrower needs to be underwritten. That borrower is part of the file, obviously, right? Somebody with a 620 credit score versus somebody with an 820 credit score is going to be completely different. The person on the secondary market is going to see a value different. Another thing would be payment history?
Possibly. Well, it's
meaning seasoning, or do they not
care?
You
mean on the note value? Yeah. Yes. It's not linear, but obviously non-seasoned is worth less than seasoned. But
so let's say we season these for 6 months.
6 to 9 months is the optimal seasoning.
Okay, what does that mean? That means that this person that I gave a loan to, right? I covered their cost of the tiny home. They now have to make payments and prove the payments, and we have to keep the records clean. We have to keep those payments to show that they have made payments for 6+ months. That makes that note more valuable to that person on the note market. What else is another thing to stack the file?
Well, you have to do servicing of the note.
Cool.
That's very, very important.
Okay, servicing is important.
The actual escrowing of taxes and insurance is extremely important. A lot of seller finance people do not do that. What we want to do is you want to mimic it. What would Bank of America do? You got to think, act, and be a bank at the end of the day, right? What would Chase do? Would they take an application from the borrower Absolutely.
Yeah.
Would they pull their credit and see if they're what their credit worthiness is? Absolutely. Are they going to make sure that if PACE is responsible for the payment, that the taxes are paid and the insurance is correctly structured? 100%. That's what it is. So the bank only gets the P&I portion of it, the principal and the interest. The taxes and insurance are paid to Allstate and the county. But they still want to make sure they're paid because guess who has rights to that if they don't get paid, right? The county is above Bank of America. I can promise you that right now.
Yeah.
They will get their taxes. That's why there's tax liens and tax sales and all that stuff. So the whole idea is think, act, and be the bank. What would Bank of America do? And that's all this stuff that we talked about right here. They all do it internally. They already have. That's why they have the biggest buildings in all the cities, because that's what they do. They control real estate. They don't own any of it. They don't own rental properties. Talked about this before, but they control it all. They don't care. They want them. That's why they write it correctly. They package it properly. They underwrite the borrower, and they make sure that all the documentations, all the T's are crossed and I's are dotted. It's because that right here, we call this the stack, the collateral stack, is what determines the value of the note right here upon exit. And I learned this a long, long time ago. I had a friend of mine that worked and sold loans at closing before the ink even dried from major banks. And this is when rates were like 4 and 4.5%, and they were selling it on the open market at 105, 106% of the value. I go, and I'm trying to sell a 10% note that I wrote
At 80%
at 80
of
or
that.
85 cents. I'm going, what the hell is going on here? And the
Does
reason
everybody
what
follow what he just said there?
Yeah.
Does that make sense? Like, so these banks, which was interesting, none of these banks that issue loans actually service their own loans. What are they doing? You go to Bank of America, what do? They give you a loan, and they've already sold it to another company, right? And they're selling it. If they give you a loan for 300 grand, they sold it to somebody else for $315,000, and they made 15 grand just selling the note. At 105% of the value, what the freak? Meanwhile, on the private market, what Nick is saying is that he would go charge somebody a 10% interest, which you would think a note buyer would want a 10% interest over a 4% interest. But the 4% interest loans were being sold at 105% of value. Meanwhile, he's over here at 10% that you'd think a note buyer would want, but he's selling them at 80%. What was the big problem? This?
The uncertainty. This right here is what you're buying. There's let me ask you a question. Anybody bought a brand new car before? Great. How many of anybody bought a used car? Are you more confident when you buy the new car? Do you go take it to the mechanic to have them inspect the car?
No.
No, because you already know it's new. You already know it was done properly. When a bank sells a note, Bank of America, whoever's buying that has a high degree of probability and certainty that they did their job correctly,
Yeah.
right? When they buy it from me or you or anybody else, do they know that I did it correctly? I have to verify.
That's interesting. Is the thought there then that even a 10% note is less valuable than a 4% note that was done correctly? Can be.
Well, think about who the buyers are, who the big buyers are.
Yeah.
Private equity groups.
Yeah.
Family offices, insurance companies. What are they trying to do with the money?
They're trying to make anywhere
They're trying
between
to-
6 to 8% and
And
have a
it's
lot
all
of
about
safety.
asset preservation
Yeah.
and not losing.
Right.
Right? That's what they get from this, the certainty of it.
Yeah.
You know,
Credibility makes the 4% worth more.
Yeah.
not to me it doesn't, but to others it does. And that's why we want to avoid having the discount. So if we can create notes that mimic what Bank of America does, we have a higher
So
probability.
is
of
step
getting
number
that.
one to find the note buyer ahead of time, sit down with the note buyer and say, this is the note I want to create. Help me understand and reverse engineer what you guys are
For
looking
this right here?
Yes.
For this, 1,000%. Because this is this is not a single family house that's anchored on land in a development that's easily appraised and valued.
Right.
Okay? Not saying it can't be, just saying it's not. It's not typical and standard. So, but it's just a different debt buyer is all that it is. Just like people buy debt on auto loans. How many do you think people that write auto loans, they sell that paper? Absolutely
Yeah,
they
yeah.
do. Do they buy non-performing debt? Absolutely. Do they buy? They buy all kinds of stuff. Credit card debt. They can buy debt for anything. It's all relative to value and perception of risk, right? We can mitigate a lot of that up front by doing this right here. This
Okay.
is the key to the whole thing.
But step number one is finding the note buyer preemptively.
For this kind of thing, I would, because this is not the same as a single family house.
Right. It would start there.
I would, that's where I would do. That's what I would do.
Okay.
It's going to give you more value.
Okay.
Because think about it, if you write $10 million in notes, okay, and the discount changes from 85% to 90%, for example, 5%. It's
a big deal.
It's a big deal. Compounded, and since this is amortized, it's even higher.
I think that I'll create $50 million in notes my first year in doing this. I have that much demand. So if I had the right buyer, here's the other problem I worry about is not only finding a buyer that will buy the notes at as high of a number as I possibly can get, but also a buyer that has an appetite large enough that I don't have to go to 17 different buyers.
Well, that was always our biggest problem in the private note space, because banks, when they sell notes, they're not selling to you and me as a note buyer. I can't go down to Bank of America and say, hey, I saw that you just wrote a $250,000 note at 8%, 7%, whatever it is. I would like to buy it. They're not going to sell it to me, right? Because they're going to package those all up and sell $100 million of paper to the guys that can buy $100 million. They only have to deal with one, not 100 of me,
Yeah.
right? And on the inverse side of it, on the private side of it, we're doing with the opposite. We're dealing with this individual. So if we want to sell this to a Wall Street type of group, they don't want to buy one $200,000 note either. So guess what? We got to build that portfolio up large enough to get us to that next level, whatever that might be. If it's a private family office, it's probably in the $5 to $10 million range, maybe 3. But that means you gotta wait till you build it up. If you're selling one a week, okay, there's 80,000 times 10, it's 800,000 times 100, it's 8 million. Okay, when you get to 100, now we got $8 million. Now we can do that. The question is, can you tread water long enough by using your own capital to get to the $8 million in a package to sell it? Make sense?
Yes.
That's it. It doesn't mean it's not worth it. It just means it's a different buyer's pool. To your point, I don't want to have to be looking over my shoulder to try to do it. But I will say this. The absolute minute that you sell that house to the buyer, it's cash flowing. The second they sign, because what happens, you have a payment that's going to be coming in versus debt that's going out, and it's always going to be more, right? You may not collect it today, but you're going to receive it because there's the payment that comes in.
Right.
Okay? So you don't have to go, oh, I'm not going to get my money. Well, you will get it, but it's just not there right now.
Right.
So this is a little bit more complex
Because of the asset type.
asset class. Is there a buyer for it? 1,000%.
It's just
how we
fun-
package it and how we position
It's
it.
finding the buyer, sitting down with the buyer, saying, what's your appetite? Tell us how to structure this. What are you looking for? What do you hate? What do you like? And then my thought is, Nick, I have a park in Big Spring, Texas.
Okay.
And in this park, this is what I want to do as a test, is I'm already going to spend $1 million on tiny homes for this park already. So my thought is, this park has 125 RV spaces, but we're expanding. And we find that a lot of the people that are there, they're oil field workers. They don't want to go buy an RV and then park it. They'd rather just have a place to stay without buying and having another RV payment. So what they're doing is they're renting the space from me $800 a month just on the pad. And then they're going out and getting a $1,000 a month RV payment as well. So they're already paying $1,800 a month. So I already know that I have built-in demand, and I can go and open up 40 tiny home spaces. Okay. I will own the tiny homes and rent them to the tenants. So I'm just doing long-term leases with these people. And these 40 tiny home spaces, I'm going to build them, and I want to finance my company with my own money and create a note that I can go off and sell. So I know, worst case scenario, I can't sell the note. Some note buyer says that they're going to buy it, but they don't buy it.
Yeah.
You know what I'm saying?
It's never an issue about selling. There's always a buyer. The question is at what price?
Exactly.
That's the bottom line. Okay. There's a price.
Because you can
for
always
it.
discount it really heavy, which I don't want to do, obviously.
No, you bet. When you finish this, there's ways that you can avoid a discount, but you have to. I'll have to show it to you. It's easy to write it. So, is there anything else we want to talk about in here?
No.
I think this is the stack. When we write seller finance, Here's the other thing. This is really, really important. I have this conversation when I speak or other SubTo people. When you do seller financing and you wrap, okay, it's not, it's a real estate transaction, but really you're a lender to a consumer. That's a big, big difference, okay? Big difference, because this right here, we're a lender to a consumer. You got all kinds of other consumer rules and guidelines.
Disclosures, all that.
Dodd-Frank, SAFE Act, CFPB can get involved, and there's all these things that you have to be acknowledged. And that's why when you write it incorrectly, if you're missing something, it's hard to fix.
Are we having the RMLO not only underwrite but also originate? So that
It depends.
Okay.
I think we would, on this situation, I would think you would want to be the originator and the RMLO.
Would I bring the RMLO in-house in that situation because I don't want to have to go out and get a license again? I used to be an RMLO.
We can solve that.
Okay, cool.
I don't know that exact answer on that. I mean, I do, but I want to think that through a little bit.
Okay, got it.
There's some pros and cons to it.
Okay.
Okay? But this is the most important thing, the stack in this collateral file right here. It's setting the tone, right? Payment history is important, but it's not that important, right? Yield is probably what somebody gets on their return on their investment. Everything is risk related, right? Is the upside gain worth the downside risk? And when you have it collateralized or it's protected by an asset, like a house isn't going to get up and roll down the street. Well, maybe this does though, right? How do we protect that from happening? There's ways we can do that. Those are the kind of things we do. But you know what? They loan on cars all day long, right? Cars are the most movable objects that you can actually lend on, right?
And dangerous.
And dangerous. All the other stuff good. But do you think people make a lot of money lending on cars?
So much, yes.
Absolutely. Do you think they have a way to protect that investment?
Yes.
Absolutely. Is there loss? Absolutely. It's calculated into their return and what they want to buy the debt for. It's just that simple. It's like anything else. So it's just the question is, can we make it fit for what you want to accomplish and get your cash out as quickly as possible without giving away the farm?
So what's my next step?
We have to solve for so everybody's probably, well, not going to assume anything. Most people understand what LTV is, right? Loan to value, okay? On the note side of it, we're less concerned about loan to value as we are about ITV, investment to value, okay? Investment is how much am I going to put in to buy the debt and what's my collateral, right? That's what banks do. So that's where the discount comes in over here. So like in this model right here, what's 85 divided by 130? About 75%? I don't have the mic. Not that good at that math, but whatever that is. Somebody want to just run that real quick. What's 85 divided by 129?
By 1.29 or by?
No, 129. 85 divided by 129. What percentage that's at?
85,000 divided by 129,000.
Yeah.
What's that number?
0.65.
0.65, okay? So this is where a lot of people, this is interesting because most people think the down payment, the borrower having skin in the game, is the most important thing from a note perspective. It's really not, and I'll explain to you why, and I'll ask you guys the same question, what you would do. Because let's just say that we write, let me see if I can do this real quick.
It's a good thing
Yeah.
you're left-handed. I like that.
Yeah,
I like
so
how
let's
we're
go,
doing this.
this right here is 65% LTV, and the rest of the money is where? Let's just call it 35% is in the second. Okay, this is the first lien first. And let's say they put 0 down payment. Okay, that adds up to 100, correct?
Right.
Could I also take of this 35? What's that difference of 30? Call it 30, 45, $44,000 is the difference, right?
Yeah.
Could I take that in $10,000 down and a $34,000?
Yeah.
Sure. If somebody said I'll give you $15,000, you can take 15,000?
Yeah.
Sure. So now it's 15 and 29. Most people think they have to put down payment. It's nice to get down payment, don't get me wrong, okay? But as a note buyer, the ones that are smart that understand how this works. And I'm going to ask you the question, would you rather have a $65,000 note that you buy for, let's call it 60? I'm sorry, what is that? I'm sorry, 80. It's 85. $85,000 note against a $129,000 asset that you pay $80,000 for, okay? Or would you rather have a 820 score borrower that gives $20,000 down, but you got a 95, you're buying it this instead of 85, you're paying par at 95.
I would rather.
But this is an A borrower, this is a C borrower.
That's really tough. Because I could justify both ways. I could say I trust the borrower, he's not going to default. However, I also am protected by the asset itself. I would probably go with C borrower.
And which is even better over here. Oh, C bar, I put C over there. I put B. Yeah, because the asset secures the investment.
Right.
Right? If this house is really worth 129, okay, I have less risk at 80 than I do at 95.
Because even the A buyer could go through a divorce, lose his
Happens
job.
all the time.
Happens all the time. Or get hit by a bus or whatever else.
It's a 30-year mortgage.
Yeah.
Life happens, man. Just does. Doesn't mean they're going to default? No. I mean, doesn't mean they're going to go into foreclosure? No. Doesn't mean they're not going to cure it? No. It just depends. I much rather be in a lower ITV, personally, I mean, obviously they can't have 3 foreclosures and 2 bankruptcies on their record,
Of course,
right?
yeah.
Because then you're just going to be fighting it over there. But this is where this comes in, right? But you got to get it low enough to justify it, okay?
Okay.
And this is why I was saying, when you write the first and the second, whatever the appetite is of whoever that buyer of that note's going to be, the institution, that's what we want to solve for. Because they might say, well, I want a little bit higher yield, but I'm willing to take a higher ITV. Or they'll say,
Like, give me 9% and I'll go up to 70 LTV.
Absolutely.
You give me 6%, I'm going to 60 LTV.
because let me ask you a question. What if this first lien right here isn't 85,000? Let's just say, hypothetical, it's only 50. And you're carrying the difference.
Yeah.
So you're in the second position between cash and second. If this is a $50,000 first lien position, secured against a $129,000 asset,
Yeah.
what's the risk here?
Almost nothing.
Much, much lower. So do you think I should sell that at a 12 cap or 12 yield to that? Probably not.
No, you could probably.
Matter of fact, I might even be able to sell this above par. Right?
Right.
Depending on what the rate is.
Yeah.
So that's it. Because here's the other thing. In traditional house, and I'm not sure on this, what typically happens in real estate?
It appreciates.
It goes up in value, right? And people go, oh, the market's down, this, that. Again, I ask this all the time.
Zoom out and look long term.
Go find me one house. Just anybody. How many we got on here? 400 and whatever it is. I think we lost a few because I started talking. But it's
No,
okay.
we got 350 people.
That's
on here.
okay. Find a house today that's worth less today than it was 5 years ago. I challenge anybody in a tier 1 or tier 2 market. It doesn't exist. It just doesn't. You can go on Zillow or a Realtor or any of those, and they got the sliding scale right on there. Just look and see what it was 5 years ago. Well, do you think 5 years from today we're going to probably have the same situation? Yes, it's going to be 5 years from today. You go, oh my God, now these are 180. Should have bought it at 130. It happens all the time, right? So real estate goes up and down, but it doesn't stay down. Oh, it's down 20%. Well, it was up 40% year before. So theoretically, we're still up 20%.
Right.
That's just it. So this math right here, we just got to solve for whatever it is, the appetite of whoever's going to do this. And there's ways that we can leverage the bunch of levers that go up and down here. We have the benefit of controlling those levers. We can control what we want the first and second lien to be. We can control how much we want the borrower to put down. At the end of the day, they're buying the first lien debt. Here's the best part about all this, and this is why we have to be a little bullish in here. And this is what I've been doing this a long time, written over thousands of these same structures. In fact, I wrote 426 deals the wrong way before I figured it out. And what I used to do was write one note, and then I'd sell it, and I'd take my money. I made a lot of money doing it, don't get me wrong. But I realized, I go, well, I'm taking this huge haircut because the risk, the investment, the value, if this was one note, okay, and let's say we got $10,000, 10% down. We got 13 down, and we're financing 117, okay? That's all. If to sell that to a note buyer,
You can sell it for like $100,000.
maybe less
Yeah.
to get it to where they want to feel comfortable about it, because the risk is still the same.
Right.
I mean, the risk is the same. It's all risk relative to
But
this.
carrying a larger second and selling the first at a
How mu-
lower
what-
price.
If I don't sell, if I write a first and a second right here, okay, we didn't write the second here, right? Let's write the second.
Second's right
Oh,
here.
If I write a first and a second, I sell the first, okay? What's my discount that I'm paying on the second that I
Zero.
sell? Zero. I'm not discounting this at all, am I?
No.
I'm keeping it.
You're keeping it and you're getting a yield of 9 to 12% or whatever. it is.
Amortized.
Yeah.
I mean, that's the secret sauce on this thing. So, and if I took 10% down on the cash, my front pocket, what's the discount I'm paying on that?
Nothing.
Nothing. So the more you can push to the second and not to the first, more money you're going to keep.
Yeah.
The question is, how do I get the cash neutral? Because you want to recycle the capital, right?
I think I can
That's the
figure
question.
I can figure that out on what I can do is I can create models on these units, and we can get a really efficient model that every buyer, I can say, hey, I can finance you nearly 100% on this specific model, and I can incentivize them to go after a model that I can get to cash neutral on the first.
I can show you. I show you how I do it, okay? And it's a pretty simple calculation, because let's just say you're negative. Let's just make a round number. You're negative $10,000 cash after you sell it to your buyer, and you sell this note right here. You're negative 10,000 cash, okay? Whatever that is, you're at 85,000, but you only get 75,000 net back.
Okay.
Where does that other 10,000 come from? Okay.
I could just add it to my second note.
Well, how much is your payment? How much are you getting on a payment on a $44,000 second at 10%?
$300-400.
Call it 400.
Yeah.
So what's 400 in the 10,000? How many months does it take to get your money back?
40?
No.
No, 400.
400 in the 10,000 is what? 25 months?
Yeah.
So in 2 years, you have all your capital back because you're funding it with this. So then now figure out the cash on cash return on that. So let's just say that you made $400 a month, $4,800. So $4,800 a month coming in against 10,000 out. Somebody want to figure out the cash on cash return? You probably know it in your head.
50% a year.
Yeah, 50. It's a little bit less than that. About 40.
48%.
Is that a good cash on cash return?
Phenomenal.
Could you go borrow that money
Yes.
for less?
At 12%, 10%,
100%.
8%. Yes.
That's how you short fund. That's how you fund the negative equity position.
Okay.
Follow me?
Yeah, yeah.
That's it. That's the math of it.
I
So,
can do that with either my own cash or the company's cash, where we can use this little stockpile, where I could short fund, take a haircut on the first, pad it with some of our own cash, and then basically the first 2 years of just replenishing what you're saying, and then everything else after that is
I think it's
gravy.
2 phases here, right? Because, and this is what I learned on the note side. When I sold my first notes at first, I didn't know what the true value of it was, because the value is what somebody's willing to pay you, right? When you don't have a lot of note buyers or a lot of people that have appetite in that kind of debt, you have limited options, right? So when you have the right options and you can create that demand, because let me ask you, let's fast forward a year. Okay, fast forward a year, you've done 100 of these, and you have the portfolio that's all been performing, right? Now you have historical data that you can leverage to your benefit. Guess what? The price goes up, right? Now I have proof of concept. I have this model. It's producing. But here's my opinion why this is such a great model, okay? And I'm not just saying it because I've done it, but who's in the second position?
Me.
Who knows this better than anybody?
Me.
Who gets paid first before Pace does? If you're in the second,
Oh. Yeah, first.
Wall Street, finance, whoever it is.
Yeah.
Okay? So when you're still in the deal, here's what I know to be true. Who gets paid first? The first lien position always gets paid first.
Right.
Right? Well, how does Pace make money? Only if the first lien holder gets paid.
Right. So they know I'm incentivized to make sure the deal works.
Hell yeah.
Yeah.
Are you going to let this deal go south?
No.
If it did go south, could you fix the problem?
Oh, 100%.
1,000%.
I would take the unit back and I'd go put it on a different park.
And that's what we used to do. Guess what? If this started going south, you know what I do? I just buy them out.
Yeah.
Could I go pay this? Could I go pay this debt off if I wanted to?
Yeah.
If I sold this note to whoever, and my borrower went to a default over here,
I just buy off the
could
note.
I just pay it off?
And I could buy off the note, keep the record for being bad, take the unit back, resell the note when I have a new buyer.
1,000%.
Yeah.
That's not the model we want to do. We want the borrowers
But
to
you want to have
succeed.
that as a fail-safe.
The times that I've taken properties back, either deed in lieu, cash for keys, whatever. I'm not sure. It's been a very, very long time. I'm not sure that I cannot tell you the last time that it financially impacted me. Usually when that happens, it's a better situation financially by taking it back and fixing the problem and redoing it. Anyway, I don't want to get off on a tangent on this. This model is very doable. It's extremely profitable. It's not for a novice. Don't get me wrong. If you guys need it, make sure you have the right people facilitating it for you.
Why do you think I'm bringing in Nick? Remember what I told you as step number 1. Know what you want, find the person in the community that has it, and bring the value to him. So what I'll do with Nick is I'll go, Nick, how can we do this together? I've got the manufacturer, I've got the buyers, I've got the cash. I would probably where would I put Nick? On the note creation side and on helping sell off the notes, and Nick would make millions of dollars with me.
Yeah, I mean, I appreciate that. I mean, very, very few. A lot of people buy and sell and trade notes, but not many people actually create them. This is a creation right here. I mean, this is like creating it from the ground up with cash or cash equivalent, not wrapping a SubTo deal.
Right.
I mean, those are great too. Don't get me wrong, and I got
Yeah.
plenty of them. But that was the initial part was already done.
Right.
You got to know how you're going to exit out of this stuff.
Yeah.
And you can do this with this model. It just depends on how patient you can be. The more patient you can be with this, the more money you'll make in long term. And I model that. I'll show all that to you. So
If I wanted to work with you on this and had you in charge of the notes, what would you want to do?
I don't know. We could talk about it. I mean, look. The most important thing is this right here, hands down, for 2 reasons. You're a lender to a consumer, okay? And depending on how you interpret the rule and the law and all that stuff, you will never win a battle against the consumer as a lender. No one likes the banks. They feel bad for John and Margaret. They think they got taken advantage of. So that's why disclose all day long. You know, that's why we use RMLOs. Because how many times do you think they got to sign those disclosures? You think the
many
Patriot Act is sort of worthless sometimes when you go to them do it? And what the hell are they asking me about that? Well, because the reason is they're signing, they're reading it, they're acknowledging it to be a true statement. If you have a borrower sign something 47 different times and they're not truthful with it, even as frivolous as the non-truth is, it still sets precedence for the file.
Right.
That's why we do it. That's
Yeah.
why we want to do it, okay? At the end of the day, our job is to make sure they are who they are, they say they are, and they have the financial capacity to make the payment.
Okay,
That's
so
it.
here's where I'm at. I've got my Big Spring Park in Texas.
Okay.
We're already clearing the land right now.
Okay.
I have the cash to pay out. Basically, what I would do is my tiny home manufacturing company is entity A, right?
Okay.
Or let's call it entity T. Okay, the tiny home manufacturer manufactures the unit. I would have another entity, which is the bank, right? We're going to go create the notes, and then we're going to have the mobile home or the RV park home where the home is going to be. Tiny home gets delivered to the spot. This person borrows money from me. Both of these are me, but obviously on paper I don't want it to look like me because
Right.
I want to go through the process. and I would go create 40 notes from these 40 tiny homes that I would create. I need help finding the buyer of these notes preemptively. Otherwise, we're basically creating a note, guessing who the buyer would be. I need help finding that buyer, and then I need help curating the note, creating a process that I can go and duplicate that 1,000 times over.
And we already built all that. That's what I
Right.
built, the perfect note blueprint, same thing.
Right.
Already have all that there. The question is, how long do we have to hold it to
But that comes
establish-
from the buyer, or
Yeah.
that comes from the note buyer.
It's all, we don't control that, right?
Right.
However, like I said earlier, is whether we're waiting 2 days, 2 weeks, 2 months, 2 years, we're still generating cash flow because the borrower is making the payment.
Right.
The question is, how fast can we recapitalize and get the velocity
And do
of
another-
capital
and
so
do
we can
another
continue
loan.
to do it?
Right.
That's where the money's made.
I've got $5 million cash now. I can go get $50 million in cash if we had a note buyer, and I could go do 1,000 of these this year.
So there's some stuff that has to happen at the note buyer level,
Mm-hmm.
right? Like, how is the asset protected? Who's going to stop the tiny home from getting hooked up to a F-150 and pulled down the road?
Right.
You know, those are things that we just have to answer.
Right.
I'm sure there's ways that we can do it.
We can anchor the units into
Can
concrete.
anchor, that makes a difference for sure. 100%.
Trackers, all that
Trackers,
kind of stuff.
all that stuff.
Yeah.
But here's here's what I would do. This is me. I just do a performance guarantee to my note buyer. Just performance guarantee it. Instead of selling this at this discount over here, what if I guarantee the performance of the note? I'm probably going to buy it back anyway. I'm probably going to go find another buyer for it if something goes sideways. So instead of taking the discount here, sell it at par. Do you want to buy it at par? And I'll performance guarantee it for 12 months. And if it doesn't work, you have the right to, you can reserve the right, I'll buy it back. Here's all my assets, I can buy back 1,000 of these. Or do you want me to discount it? Do you want to discount it without performance? What do you think they're going to say? They're going to say,
Performance.
they're probably going to say the opposite. Because they know it's not going to be, they know that it's going to perform if it's done correctly. So I prefer, but sometimes they do, maybe 20%. We want to find, my opinion, I would have the guys that we can get the higher price for, the least amount of discount, and performance guarantee it. Just say, you can't say guarantee. I don't know what the right the verbiage you would use on that, but it's a performance guarantee, right? Hey, if the buyer stops performing, you have the right.
I'll buy the
it
note
back to you.
Yeah, I'll buy the note back.
I'll buy it back to you. I'll deal with my borrower that I underwrote myself. We can rework the deal. We can do whatever we want, and then we build it back up and resell it. Whatever. You'll make millions more dollars because we already know what the default rate's going to be on this. It's not going to be that. It's not going to be that high.
Yeah.
It's not. It's just not. If it's done correctly. If this is done properly, it just won't. It's just not going to be a problem. Everybody thinks it's a problem. You know why they think it's a problem? Because they hear all these stories about note buyers, about stuff going bad. Why do you think it goes bad?
Because they created the wrong file.
Because they didn't do that.
Yeah.
83%, that $30 billion I said earlier, 83% of those notes that are created are done by what I call mom and pop note creators, okay? One and done. They're not professional note creators. Guess what they don't do? Oh, darn, I forgot to put servicing in there.
Yeah, I'll do it myself.
I'll do it myself.
I'll save the $17
No,
a
you
month.
don't. I don't want you to. You pay the taxes and insurance whenever you want.
Yeah.
I trust you. It happens all the time.
Or they accept a borrower with a 520 score because they put a big down payment down or something.
Yeah, or they had a renter and then they convert them into a buyer that was giving them cash every month at closing. This is the key right
It's a
here.
messy file.
Messy file. I always say,
Are you guys learning anything?
what
Is
would
this
Bank
like,
of America do?
Do
You
you-
act and think like a bank.
do you see I follow my own instructions? Do I pretend to know everything, or do I go to Nick and friends of mine that I go, hey, by the way, did you know Nick is in SubTo and helps a lot of SubTo members create notes and do all sorts of stuff?
I do now. Although I'm pretty much retired from all that stuff, but
Yeah, but
I'll
then
help
I-
you.
but then I send you a text.
I'll come out of retirement. Exactly. No, this is a very doable model. Is extremely attractive if packaged the correct way. It's not for everybody, but guess what? We don't need everybody.
Right.
You know,
I literally have, I'm not exaggerating, I have 500 people lined up going, I'll buy 30, I'll buy 40, I'll buy this, I'll buy that. I'm ready to go. I've got the land, please put it. I could sell 1,000 plus this year if I had the capital, but more important, I could find the capital. The biggest thing I need to help with is on the notes.
Well, I can definitely help structure.
Do you know anybody that knows anything about notes?
Not anymore, but I probably know a guy.
Okay.
Depends on the state also. That's another thing we
What's
gotta
our
do.
next step?
You just tell me when you're going to show up on time for a meeting, and we'll be good to go.
The way you educated this was I think it's very basic. Now, how is it applicable to other people? It's actually very applicable because when you buy it, let's say I buy a SubTo deal, right? A single family SubTo deal. We were just showing you where to find them. What are you doing? A lot of times your exit strategy is what? You could turn into a rental you own yourself. You could wholesale it to somebody else, or you become the bank and you seller finance it to somebody else on a wrap or a lease option. When you sell on a wrap, you just become the bank. And you just created a note, which is what Nick has done thousands and thousands of times. So is this pertinent information? Yes. Is it applicable? Everything you just learned here, is it applicable? Yes. Could you go create a note? Let's say I go to a homeowner that's in foreclosure, the person I talked to today. I buy that house out of California. It's a 2.6% interest rate. I buy it SubTo. I turn around, find a family that's willing to pay 7% or 6% interest on the same house. Did I just create a note? Yes. Could I go sell that note to a note buyer?
Absolutely.
Yes.
Could you make money doing it?
Yes, a lot of
But
money.
could you also lose money doing it?
Yes, you can.
Absolutely.
You could also lose money by doing nothing.
You can surely do that too.
Yes.
But this, look, you say it all the time. You don't need to know how to do this. You just need to know who can do it.
Yes.
And I might be faster than pace, but that doesn't make me faster. I mean, it doesn't make me fast. It just makes me faster, right? This right here is an extremely complex process, okay, to do it correctly, okay, like a bank does it. And there's a lot of people that say they can do it, and you believe that they can do it because they're smarter than you or faster than you when it comes to this. And I'm talking about title companies. I'm talking about attorneys. I'm talking about servicers, underwriters, all of them. Just because they're in business and they say that's what we can do doesn't mean they can't. I mean, this model that we just showed right here, this is the same exact model that I sold back in 2018 to a 100-year-old federally chartered bank. Okay? Does that mean I'm the smartest guy? Absolutely not. It just means that I went through 10 months of hell of due diligence from a bank under a microscope underlying the entire process. So I always say if it was good enough for a bank, it's probably good enough for most. Could it always be improved on? Absolutely. We want to deal in probabilities, not possibilities. This is a highly probable model for success if it's structured properly, and it's a highly probable model for failure if it isn't done.
Okay.
There's not a lot of margin here.
On this deal, okay, so whatever the note buyer wants, I can create. Meaning, let's say the note buyer says, I need these anchored. I need them to be HUD approved. I will build HUD approved houses. I will anchor them. I'll do whatever.
100%.
If the note buyer's like, no, I'm not going to do a non-anchored tiny home, cool. I also will need to find another note buyer that is willing to do that. But I will build the 40 tiny homes or the 40 homes on my park that fit whatever the note buyer is willing
How long
to.
will it take you to get to 40?
Probably 60 days.
You can have 40. So
There.
you're going to set up one as like a model, and you're going to use that as a sales office kind of thing?
I
gonna
mean, they're
sell?
all just renters. So, and we
Okay.
already have a list of people. So
But
the
who-
people who are renting these from us are oil field workers, and they work at a local oil field company.
Who's going to be the buyers for the 40 that you're going to put in?
I own them. I'll own them on my
Oh, but
park.
when you go do this right here, is that
Me.
something? Oh, okay. So you're going to own all of 40.
So this is what's confusing is
Okay.
I'm also
I gotcha.
I'm the borrower, I'm the bank, and the manufacturer in this
Gotcha.
particular situation because I want to go
Well,
through.
that's going to be super easy because we can cross collateralize or whatever
Right.
your debt.
Right.
It's not Bob and Sue that are buying their first home that works down at the Buc-ee's. that
The
they put in.
only, I mean, I want to go through the process on a borrower that's a good borrower. I own the land, right?
Yeah.
I'll anchor it if they want me to anchor it, and I will come up with the cash, cover the entire cost of it, create the note, have all the patience in the world.
We can do all that.
Yes.
That's not going to be a challenge. So you're saying, just I want to say what I think you said, the first 40 They're all going to be Pace's the borrower.
Correct.
Okay, not Bob and Sue.
Correct.
Okay.
Once I go through the process, we sell those 40 notes off, I feel good about the process, then I can open it up and go, all right, we've gone through the paperwork, you know the process. More importantly, the most important thing, you already know the paperwork and the process. It's, is the note buyer going to perform on what they said?
Right.
Because worst case scenario, I am going to buy these 40 units from my RV park regardless. So
Right.
why don't I just go through, create a note, sell the note?
This is the key. The asset's going to dictate the
Note buyer.
note buyer
Yeah.
and what they're willing to pay and what they see the perceived risk.
Any questions on this at all? Any confusing stuff? Go ahead.
Yeah.
You open your mouth.
No, I was just.
You're like, what the hell? This is crazy.
No, I was just thinking, like, you said leave the wheels on or not, or have an anchor or not. So are you gonna then have the land lease? So you have, like in a mobile home, you have your home, which you can
Right,
run,
yeah.
but then you also still have your land lease.
Yeah, so on these ones, the people that are living in these ones are my tenants, and I will just rent the unit to them, and it will include the lot rent and everything all in one price. So they won't have a lot rent and a home rent, they'll just have one home rent. And so I'll charge like $1,800 a month per, I'm actually, this is what's cool, is I'm actually turning these into duplexes. So there's one livable side on one and one on the other. And so I'll charge one rent side $1,800 a month and the other one $1,800 a month. I'll bring in $3,600 a month per tiny home or per modular home, and I'll anchor them onto the ground so that, I mean, I don't want to anchor them on the ground. The reason why is because my future borrowers are going to go, I don't want to go through the same process you went. I just want tiny homes in my park producing money. And so in a perfect world, I want a note buyer. This is where Nick would come in. I don't have time to find a note buyer. I don't have time to go through all this stuff. This is why you bring other experts in and you let them make a bunch of money too. Is in a perfect world, I would have a note buyer says, we'll finance tiny homes that are just literally bolted to the ground. We're cool with that. In fact, you can keep the wheels on. Somebody can pull them away at any time. We don't care. That's the perfect note buyer for me. But on my first process, on my first 40, I'll do whatever the note buyer wants to establish a relationship with them and go through the process of it. And then we might end up having 3, 4, or 5 different note buyers based on whatever product we're creating. Some note buyers will go, I will not touch something not anchored and concreted to the ground. Other people go, we're cool with it, but we want a discount on the note. So that is where Nick would come in and interface with the note buyer so I don't have to.
So are you gonna let this concept go outside of your parks as well?
Yeah, oh yeah. I'm going to finance everybody inside of our community. My goal is to do 100% financing for anybody who wants a tiny home or a modular home on their RV parks in the community.
So what if they're not in the community? They're like, hey, I want to do that tiny home thing like Pace.
They can kiss my ass.
Yeah.
The reality is I have enough demand inside the community. Why would I go out?
The only reason why I was asking, like, if it was, I just know that I owned a tiny home and the bank that I dealt with, you had to take the wheels off. It had to be anchored.
Yeah.
And that was in there.
Well, that's what we just talked about. That was the buyer, note buyer, right? The bank is the note, right? And so they own the note, so that'd be no different than they created the note, so that's their rules. And if we're gonna, no different if we create it or sell it, whether they created or they bought it, I should say, their rules aren't gonna change, right?
Right.
Because that bank, because let me ask you a question. If you take this right here, this portfolio right here, we talked about hypothecation, right? Could we take that whole thing and hypothecate that to a bank?
Yes.
And guess what they're going to say? Well, we'll do it at this rate or this discount, or not discount, but this value, and you have to anchor it. Otherwise, we're not interested.
Right.
It could just, because you remember, where does banks get money from? It's everybody. They have
Pension funds, all that stuff, yeah.
they have rules they have to abide by. And if you go raise capital, you have rules that you have to abide by too. And that might say, hey, if you're going to lend on anything real estate, it can't be manufactured homes, or it can't be automobiles, or it can't be something that can drive away.
Right.
So we have to solve that.
Now
Or we
you'll
have to
get, so
guarantee.
where things change a little bit is that, let's say you go to a community bank. A local bank has the ability to create a new loan product and they don't have to follow any rules because they're doing it with their own money. They might have shareholders or whatever, but they can create just hold that note on their own books. But now they're stacking up notes and they're not selling them off to redo that. So you'll tap out a credit union, really quick. You go, will you buy 100 million? They go, no, but we'll buy 5 million. Crap, now I got to go to another credit union. So really if you want to go fast, you got to find a note buyer with an appetite of $50 million a year of the same product. Once you know the note buyer, you can then reverse engineer what material and what product you're going to create and what you're willing to finance to people. I can almost create anything I want. I need to know what the note buyer is willing to finance and buy from me. Once I know that, I'll create that product. And I'll also put a crew together. So for example, let's say we sell a tiny home. The note buyer says, we're cool with the tiny home, but you have to bolt it to the ground. You have to get somebody to put bolts in the concrete. You have to take the wheels off. I don't even care what you do with the wheels, but they can't be on the tiny home. And you have to put skirting around it. Okay, well then I'm going to train my crew that delivers the unit to do all that work so that when it leaves, it's been documented, filmed. We have photos of every single unit. So when it goes into the file to sell the note, the bank can open up and go, oh, yep, it's been bolted down, it's secured, it's this, that, and the other. But what if I find a bank that goes, we don't care. You can keep the freaking wheels on there. In fact, we prefer the wheels to stay on there because if somebody defaults, we want to pull that unit out. You don't know until you talk to the note buyer.
Yeah, it's sort of like rehabbing a house that you're going to sell, right?
Right.
You over rehab it, you lose money, or you do go paint the walls gray. 5 minutes after you sell the house to the buyer, I don't want gray, but they like the house. They go paint the walls blue.
Yeah.
Well, that was just wasted effort. Instead, if you could have asked the buyer ahead of time, what color walls do you want? Then you could have killed two birds with one stone. It's the same thing. We want to reverse engineer this. To your point, figure out what that's going to look like, and see that we can fulfill it.
Yeah.
The fulfillment's easy because we just say, yeah, no problem, we'll do whatever.
Right.
It's easy. Last question I have on this: how do you determine fair market value, appraised value for these?
Just comps, what other people are selling for, other competitors.
But are you going to all be yours, aren't they? Because they're going to be all yours in the community, I guess. Just like a new home builder.
Basically, I'll probably set my own comps to a certain degree. But right now, like if you go out to the open market, you can see what other competitors are selling something similar. I'm at the same price.
Got it. All right. What else you got? Is that it?
That's it, dude.